Hey everyone, so today we're jumping into a strategy that's getting a ton of attention, especially for new investors, copy trading. We're going to break down what it is, how you can do it safely, and most importantly, how to tell if it's a smart move or, well, a dangerous shortcut. Let's dive in. Okay, first things first, let's start with a reality check. You see this number? Roughly 2/3 of regular investors actually lose money. Now that's not meant to scare you off. It's just to ground us in the fact that, trading is hard. It's really hard. It takes a ton of skill, a lot of discipline, and you really have to understand risk. For a beginner, that learning curve can be incredibly steep and pretty expensive. So that really makes you wonder, right? If just diving in all by yourself is so risky, is there a better way to maybe dip your toes in the water? What if you could learn from traders who've been doing this for years, not just by reading about them, but by actually following their moves in real time? This is where a whole new approach starts to look pretty interesting. And that brings us right to the main event of this whole explainer, the promise of copying. The whole idea behind copy trading is to tackle that steep learning curve head on. It gives you a way to get into the markets by kind of piggybacking on the expertise of others. But what does that really actually mean in practice? It's really important to get the difference here. Think of social trading as like a financial version of Instagram or Twitter. You can see what traders are doing, you can share ideas, you can watch strategies play out. Now, copy trading, that's the next step. It's the buy button. It's the automated function that lets your account make the exact same trades as a seasoned investor you've decided to follow. So you're not just watching anymore, you're actually doing. So let's say you're interested. Your very first move isn't picking some hotshot trader to copy. It's picking the right place to trade. The platform you choose is the foundation for absolutely everything that comes after. And trust me, getting this wrong could be a huge, costly mistake right from the start. So here's what you've got to look for. First up, and this is totally non-negotiable, regulation and security. You want brokers that are licensed by serious, top-tier authorities. That is your number one safety net. Second, you've got to understand the costs. They can be kind of hidden in fees, spreads, and commissions. Third, check the minimum deposit. Does it fit the budget you set for yourself? And finally, how easy is it to use? You do not want to be fumbling around with a confusing platform or a clunky mobile app when your money's on the line. Now, what's really cool is how different platforms are built for different people. Take eToro, for example. It's known for being super beginner-friendly, and it has this massive social community. Then you've got something like Exness, which is great if you're focused on Forex, and they have really low minimums to start. And then there's Pepperstone, which is really for more advanced folks who want powerful tools and super low spreads. So you see, there's no single best platform. There's just the one that's best for you. Okay, once you've got your platform all set up, you come to what is probably the most important decision in this entire process. Who are you actually going to copy? This one choice, more than anything else, is going to shape your experience and your results. Let's keep this really simple. Here's a 4-step checklist you can use for any trader you're thinking about. Instead of just getting blinded by some huge return percentage, you need to dig deeper. You need to look at their risk score, a key number called the drawdown, and see how many other people are actually trusting them with their money. So let's start with those flashy return numbers, shall we? Okay, here's the deal. A trader showing a 200% return might look like a genius, but they could have gotten that by taking absolutely insane risks, the kind that could blow up an account tomorrow. What you really want to find is consistency. Look for someone with a steady performance over at least a year, not just one lucky month. A nice, smooth upward curve is always better than a wild, unpredictable roller coaster. And that brings us to maybe the most critical number that most beginners just totally ignore: maximum drawdown. It sounds a little technical, but it's simple. This number shows you the biggest loss a trader's account has ever taken from its highest point. So if a trader has a 50% maximum drawdown, it means at some point their account value was literally cut in half. This is your best crystal ball for their worst-case scenario. And this quote just perfectly illustrates why that drawdown number is so important. The math of recovering from losses is brutal. If you lose half your money, you don't just need a 50% gain to get even again. No, you need a 100% return just to get back to where you started. This is why avoiding big losses is so much more important than chasing those huge gains. Alright, so we've picked a platform and we've picked a trader. But hold on, before you put a single dollar on the line, we have to talk about your safety net. I know this isn't the most exciting part, but it's the part that's going to keep you in the game for the long haul. This right here, this is the professional standard. You should never, ever risk more than 1 to 2% of your total capital on any single trade. When you're copy trading, that means your settings, your stop losses, have to be set up to make sure that no single copied trade can cost you more than that. This is the absolute foundation of protecting your money. So here it is, your survival toolkit. You've got the 1-2% rule. Next, diversify. And I don't just mean stocks, I mean traders. Don't put all your eggs in one basket. Copy 2 or 3 different traders who use different strategies. And definitely use stop-loss orders on your whole copy portfolio to decide the maximum you're willing to lose. You can even set weekly loss limits. If you hit it, you just stop, take a breath, and reassess. It protects your money and your sanity. You know, when it's all said and done, it really comes down to this. Following the rules and that safety checklist, that's what separates investing from gambling. An investor has a plan, they manage risk. A gambler just chases wins and makes decisions based on emotion. Copy trading can be either one of those things, and it's your discipline that decides which path you take. Okay, we have covered a ton of ground. We've laid out a whole plan for how to get started with copy trading. So let's just boil all of that down into the most important takeaways you need to remember. Look, if you remember anything from this explainer, let it be these 4 things. 1. Only use regulated platforms. Period. 2. When you're picking a trader, dig deeper than that big shiny return number. Look at their risk score and their drawdown. 3. Managing your own risk is your job, and it's your best defense. And finally, number 4. Start small. So many platforms offer a demo account. Use it. Practice this whole process without risking a single penny of your real money. So, we end right here with this question. Is copy trading this amazing strategic tool for learning, or is it just a dangerous shortcut? The thing is, it can be both. The tool itself isn't good or bad. Its power to help you or hurt you is determined entirely by the person using it. The difference, as it so often is, comes down to your discipline.